Hi, we are going to look at the BCG framework on how does the management evaluates the companies which they are operating. Okay, you would observe, by the way, and you surely would have experienced that a lot of large conglomerates wherein there are a variety of companies within the same group. Okay, so there could be a company, for example, or there could be an organization which would be operating in hotels, and then food, and then airlines, and also some manufacturing, maybe stationery, maybe tobacco, and stuff like that. Okay, so the point is that why are they doing this? Okay, why are they so complicated as a structure? Okay, one of the views that we understand is that they don't want to really kind of put all their money into one kind of a business, or even so as to say, if you go to micro level, in one category of a product line. Okay, so what they would like to do is they would keep on evaluating what's going good, what's going bad, and accordingly the decision making would happen in terms of should they continue with an investment the way it is there, or should they pull off their investment out of that portfolio, or should they invest even more in a particular category of a business, right? And that's what the BCG framework tries to tell. That, and it's a very simple structure. It only talks about two variables. One is the market share, and second is the market growth. Okay, and it's a clear matrix, the BCG matrix as we call it. There could be a part of a group. It could be a company within the group, or it could be a product line within the group, right? Which the company is selling. Okay, so there could be, let's say, a business unit. So let's name it a business unit for the sake of a better understanding. So there could be a business unit which is doing very well, in the sense that it's growing very well. So it's a high growth. And the market share that you've got is also very high. Okay. Likewise, there could be a business unit which is in which you have a high market share, but the market is not growing any far. Quite likely that the markets are matured, but you have a large stake in a business already. Okay, we'll come to the terms in a while. And then there could be an instance where your market share is low, but the growth is significant. Okay, so the markets are growing, but you are just a small player within that community. Okay, and finally there could be a category where there's not even a growth. Okay, so there's a low growth as you observe it here, and your share is low as well, right? So the point is that all these businesses require money. Okay, you have to operate your businesses, and you need money to operate those, right? The easiest among those easiest among these category is this one, something referred to as a cash cow. Okay, I know that my share in the business is fairly stable, and it's significant as well. It's a high market share I've got, and the market growth is stable too. This market will not really grow any far, and I'm making my money out of this scenario. Okay, this is where your operational cash is quite high. Okay, and as you understand that you have a ready share, and the market is stable. It is not really growing. It is settled down. Settled at the place where it is. You would prefer to use the cash and invest it somewhere else, since the markets are not growing. The cash is stable, so it's as good as working on its own. It's working as an autopilot. And that you would use that money to probably invest in high growth businesses or the business units. Okay, right? Likewise, there could be a category or a BU in which your share is high and the growth is high as well. So it's a kind of a business wherein you know that whatever you are putting in, so that there are two perspectives. One is that you need to keep this going, you need to keep this high, and it is really making more value because even the growth is very high. Okay, so what you would prefer to do is you would certainly want to use much of this cash, okay, into this category. So you would normally see a movement from a cash cow to a star business, because that is where the returns are expected to be even more, and gradually you would observe that this star, when the market growth stabilizes, when the business cycles are changing, when it reaches that its maturity level, then very likely a star would become another cash cow. So you really want to kind of operate it like this, that as much stake as you can build on this star kind of a business, eventually that would become an autopilot again, and that would be a continuous exercise where you use that money from the cash cow and invest in again high growth businesses. Okay, that's what these top management are always keen to look at. Okay, so what I was saying is, now there could be a cash cow wherein you have a high market share but a low growth. That is somewhere the cash is pulled off and invested in, for example, into a star where the share is equally high, share is high, and so is the growth. Okay, but then there could be some businesses which are allowed to die. Now this could be a very cruel term to pick up, but within the portfolio there could be a business where neither you are doing good, you are a small player, you have a low market share, but the growth also of that particular business is low enough, right? So what you would do is, probably you would exit this business because it does not expect to offer you anything in return in the short and the long term, and you would probably again pull off the money and want to transfer this fund somewhere else. Okay, so this is again a clearer picture where you have a low market share and a low growth of the industry, and I think the most interesting one is this category where you are a small player nonetheless, but the market growth is very high. Okay, and that is where it's a question mark, because while you are thinking the markets are growing, but so are the other players. So everybody would like to earn their share of the market, okay, because the markets are really growing there, and that is where you need to kind of really ask a question to yourself: should you put money or should you stay away from here? Okay, and the fact is that if you were to put your money, there is no guarantee, there is no clarity that this money would really reap significant benefit, because everybody is sitting and looking at the same stake and you are just a small player. Okay, so there is a question mark here: should you be putting money into this business or should you simply stay away, because there's a likelihood the entire money dies. Okay, a lot of investors, a lot of people would want to really wonder how to deal with this. Okay, but then that is something which is this the portfolio evaluation of the BUs or a company or a product line for organizations, when they want to observe how should this entire evaluation be done under the BCG framework there. Okay, so that is something which is the key perspective. You really want everybody to become a star, but of course most of the times you find a challenge with the question mark, because you don't know how to deal with that part, and eventually you expect the cash cow to be using the funds to to put it into a star or maybe even to a question mark. So that is how broadly you would like to evaluate. And the interesting part about all this discussion is that when you look at in today's world with the technological things around us, most of the largest businesses around the world, they don't necessarily look into the perspective like this. Okay, although there could be an argument that maybe at a business unit level they don't talk about it, or a company level they don't talk about it. It could be a case as far as a product line is concerned. So one way or the other, directly or indirectly, the BCG framework would play a role again. Okay, a company like Google, a company like Microsoft, a company like Facebook. Okay, so they may say that we are only doing this kind of a work. Apple, for that matter. Okay, so they may say that we are only doing this kind of a work. So we are not into a company or a business which is doing everything. They are not into airlines. They're not into hotels, etc. So that's not a kind of a structure that you expect in such organizations. But the fact remains, within technological space, they may be doing multiple layers of work. Okay, we can argue Microsoft is a software company. There's no problem with that. But what kind of software, what kind of investments, what kind of the changes of the technologies, that's where the next step of conversation starts coming in. Okay, is it an entrepreneur product, or is it on the clouds or something like that? You look at multiple layers of stuff, and that's where again the BCG would come into play, that you would probably allow a very small piece which is not growing to let go, so that not concentrating too much on this small piece, because it's not worth it. You pull off that your investment out of that, and you start searching for stars and even the question marks, and that is what is the whole perspective of BCG in our discussion here, right? So that's it from my side. Thank you very much. Good day. Take care. Bye bye.